Hello and welcome to a brand new episode of Smart Money. On today's episode, we're doing a book review. Now, the book under review today is called Let's Talk Mutual Funds. Now, the author of the book is Monika Halan, who needs no introduction, but I'll do it anyway. She's a personal finance writer, speaker, and author who helps families get their money decisions right. Monika is the best-selling author of the book Let's Talk Money, and this is her second book on how mutual funds can help you achieve your financial goals. She joins in now. Monika, thank you so much for joining us on the show. And I had a chance to go through the book, and I must say it's a comprehensive piece on how mutual funds can help you achieve your goals. So congratulations on the release of the book.
Thank you so much, Sonia. What a wonderful, it's great to be on your show. And I'm looking forward to this conversation.
Oh, yes. And so am I, right? So, but for anyone who's starting off, and we know we've had this discussion that there are so many people from affluent families, people who are wealthy, but they still don't know how to manage their own finances. So for anyone who's starting off, what should be your primary goal when it comes to money?
Sonia, it's very simple. When you start to swim, you don't go to the deep end, you don't go to the sea and you start flapping. You learn to swim in the shallow. When you start to learn driving, you drive very slowly, you take instruction, you don't crash the car. It's no different when it comes to money unless you know the basics. How can you ever deal with something like market-linked equity or even market-linked debt? So my recommendation to everyone is that get your basics in place, get your cash flow system in place, get your emergency funds, get your insurances in place. Only then you start investing. So I come to investing in Let's Talk Money really by chapter well into the book, chapter 8 or 9, that we actually begin investing, which is why mutual funds is book 2, because it's only after you've got your basics in place do you begin. And my very basic baby step is to get your cash flows in place. It is such a powerful tool that each of us have to have oversight over our spending and our saving. So that's your baby step, just oversight over how much you save and how much you spend every month.
Okay, that's very important, right? More than the saving culture, I think it's the investment culture that we want to sort of talk about and enlighten people about. So since your book is primarily focused on equity investments, and you've talked about how equity investments are a great tool to build financial wealth over the long term, can you help us understand the different types of equity categories? And I know that there are 11. Of course, when we get into schemes, it's a whole different ball game. There are so many 200, 300 schemes. But just talking about the equity categories for the benefit of our viewers.
Sonia, the way that you start thinking about choosing a fund. So like you said, equity has 11, debt has 16 categories, and an average person doesn't need all the categories. So instead of starting with choosing schemes, you first shortlist categories. And of the 11 equity categories, you need at most 3 or 4 of them. The simple ones that you start with, of course, is large cap. Then you give a return kicker with mid and small cap. And then there are blends, like large and mid cap is an interesting category to look at. A lot of the other categories, I would say you wait until you are more proficient in mutual fund investing. And then it's a tactical move whether or not to have a sector fund, whether or not to have a focused fund. A lot of the categories, when you finally see the results over a 10, 15-year period, will underperform the basic large and mid-cap fund. There are many, many other categories out there of these 11. At least initially keep it simple. So for an entry-level investor, I always say just start with a basic index fund, either on the Nifty 50 or the Sensex. But that's just to get a flavor of it. And then you start diversifying your portfolio. So keep it simple, keep it to something you can understand, and a very beginner kind of a portfolio after you've tasted this product, mutual funds through index funds, is to have half of your equity portfolio in an index fund and a quarter in a mid cap and a quarter in a small cap. The caveat is that this is a long-term portfolio. You are not thinking of less than a 10-year investing horizon at least. These are also forever funds. I call them forever funds. When you spend the time choosing these funds, imagine that they're partnering with you for your entire life. So this opportunistic moving in and out is something you leave it to the fund managers, you leave it to the speculators. You need a steady mutual fund portfolio partner, and that's how you think about your money, Sonia.
Absolutely, absolutely. I completely agree with you. And you said 50% of your portfolio should be in a, in a large index fund, and the rest in mid and small cap funds. But that's about passive funds, right? I just want to finish this argument on the different categories. So we did, of course, have that plate on the screen about different categories, whether there are thematic funds, sectoral funds, value funds, contra funds. There's, diversified flexi cap funds as well. For someone who's slightly more aggressive, has age on their side, do you recommend getting into any of these fund dividend yield funds, for example?
Right. So I'll tell you a little bit of background is that a lot of the categories survived because the industry negotiated with SEBI to say, look, there is so many 1,000 crore of AUM still in these funds. So you will be curtailing innovation and harming investors if you take these categories away. This is pre-2019 when the categories were fixed. So there are a lot of legacy categories out there. But if you look at what is the basic idea that a portfolio, what should it do? It should give you at least market return, and then it should beat the benchmark. So the mid and the small categories that I mentioned are not passive funds. These are active funds. So I'm saying do a blend. Do passive in your large cap and do active in your mid and small cap. Now you mentioned other categories. So again, thematic and sectoral are for mature mutual fund investors or risk-taking, where you personally have a view on a certain sector. And this becomes a slice of the pie, Sonia. It's never the entire pie. So then you do, okay, 15% in a sector that I think is a sunrise sector in India, or a theme that I think is a sunrise. So 15%, 10%, those are slices of the pie. Always remember, it is never the entire pie in a sector fund, it's a slice. And then there are two similar scheme categories, which is flexi cap and multi cap. Right, so flexi allows the fund manager to go to any large, mid, small cap. It's a tactical call that they take. Multi-cap, SEBI enforces mutual funds to put at least 25% in every cap, large, mid, small. So what happens is fund managers have a large cap bias. If you look at the portfolios of flexi cap funds, they are giving you almost large cap returns.
Absolutely.
Isn't it?
It doesn't make sense to duplicate your funds, right? I mean, you'd rather just have it in a large cap fund than in a flexi cap fund.
Right. So if you don't want to do this portfolio allocation yourself, so a multi-cap fund which enforces the fund manager to put at least 25% in each of the categories gives you that 50, 25, 25 balance, because right. So be sensible about your allocations. Don't get taken in by flavor of the month, flavor of the year. You see what is a good portfolio. And again, the book gives you 4 or 5 model portfolios. You can customize it to yourself. But the idea is that the one weapon in your hand is your asset allocation.
Yes.
And within equity, it is your allocation between large, small, and mid. So then your decision to rebalance is always in your hand, and it doesn't depend on the market. So remember, every time you want to take control, rather than give control to something like a market or a theme or a flavor, you need to keep that control always.
Got it, got it. And personally, Monika, I don't know whether you agree with me, but personally, I believe that for a longer term wealth creation journey, you need to remove the fund manager altogether from the equation, right? Because there's so many, there are human biases, there are behavioral biases. So it's better to just stick to passive funds for someone who's in it for the long haul. So let's talk about that. Within passive funds, right, there are index funds and there are ETFs. A lot of people don't understand the key difference between these two. So explain that to us, and what should I be choosing?
Right. So index fund is simply a mutual fund which mimics an index. It could be any index. If you want to learn what indices are, Let's Talk Money has explained it exhaustively. So it's a mutual fund which is mimicking an index. It could be the Nifty, it 50, it could be the Sensex, it could be any of the hundreds of other indices that exist in the market. Right? So you can have a small cap index, you can have a mid cap index. That's an index mutual fund. An exchange traded fund was a product developed for traders, essentially day traders, who wanted to move in and out of the product. So it is also an index fund, except that it differs in its flavor so that it's a product which is listed on the stock market, so you can trade through the day. Now, the idea of a mutual fund is it is for a retail investor who are long-term holders of the product. So why would you want a product which is meant for a trader? That's my first problem with it. The second is there are liquidity problems with ETF. An index fund is the mutual fund has to provide, has to buy and redeem, has to sell and redeem an unlimited number of units at all times. So mutual funds can go on creating units, and it has to maintain cash and has to always have money available for redemption. So you can go to the market with a large order and immediately within whatever, 1, 2, 3 days, get your money. An ETF needs to have a counterparty. So there are market makers, but actually try going with a large order with an ETF and you see how difficult it is to sell. Right? That's the other part. Then there are other things like you need a demat account. There are costs associated with it. When I'm saying keep it simple even in terms of managing your portfolio. That liquidity. Remember, it's not just return. Huh? Investing is not just about return. It's also about ease of transaction. It's about cost. It's about liquidity. It's about knowing that when you go, there is a party on the other side who will buy whatever you have to sell.
Absolutely.
For a retail investor, it is so important that this happens.
Okay.
So I prefer that investors go through the index fund route. The ETFs still have liquidity issues.
Got it. I agree with you completely. I mean, index funds are far simpler, lesser costs, and you get good sleep at night, right? I mean, why do you want to bother doing all that hassle when there's somebody else to do it for you? Just benchmark the index and follow the India growth story. Okay, Monika, I know you have another point to make, but I'm going to take a quick commercial break. Don't go anywhere. We'll be back with our guest talking about her latest book, Let's Talk Mutual Funds, in just a bit.